I think what's going to happen in the near term is we're going to get in the West, led by the US, but also in Canada and in Europe, we're going to see interest rates come down. We've seen it in Canada a couple of times, of course. We've seen it in Europe. And we're just waiting for the Federal Reserve to cut rates. And typically, when the Fed cuts rates, gold always moves up from there. We'll see a slowing economy, and a slowing economy is actually positive for gold, not because of a direct correlation between a slowing economy and gold, but because when the economy slows, investors look ahead and say, that means more easing on the part of the Federal Reserve, which is positive for gold.
The gold market has finally received the signal it's been anticipating since mid-2022, as the Federal Reserve hinted at potential interest rate cuts as early as September. This development has propelled gold prices to unprecedented levels, with the precious metal surpassing $2,500 per ounce on Friday for the first time in history. Federal Reserve Chair Jerome Powell stated in a recent press conference that a case could be made for a rate cut as soon as the next meeting, marking a significant shift in monetary policy. This pivot, coupled with rising geopolitical tensions and signs of a weakening U.S. economy, has fueled gold's remarkable ascent. Adrian Day, founder and president of Adrian Day Asset Management, a firm specializing in global and resource investing, provides insight into the factors driving gold's stellar performance. Day highlights central bank purchases, led by China, as countries seek to diversify their reserves and protect against the weaponization of the U.S. dollar. Additionally, Chinese investors are turning to gold due to concerns about their domestic banking system and limited alternative investment options. Day expects anticipated interest rate cuts in the U.S., Canada, and Europe to bolster gold prices further. He also notes that while an economic slowdown is not ideal overall, it could increase investor interest in gold as a safe haven asset. The recent loss of momentum in the U.S. labor market, as evidenced by July's data, has added to the economic uncertainties propelling gold's rise. However, the surge in gold prices is not without its consequences. In a recent report, Goldman Sachs Group analysts noted that the price increase is impacting cyclical Chinese consumption. Nevertheless, they suggest that increased demand driven by economic uncertainty and lower interest rates roughly offset the negative effects of lower incomes. Please tune in for our exploration of Adrian Day's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
We know why gold is rising at the moment. So I'll answer the question, but from a different point of view, if I may. We know why gold is going up at the moment. Gold is going up, number one, because of the central bank buying, led by China, not the last 2 months, but led by China. But many, many central banks are buying gold, and they're buying it to diversify their reserves, and specifically to try to isolate their reserves from the weaponization of the dollar. So, the weaponization of the dollar, in my view, is not a good thing, but it's not like a global catastrophe in the sense that you're asking your question, I don't think. That's been the primary driver of gold over the last 18 months. Maybe a third of all gold buying has come from central banks. You've got Chinese buying, Chinese investors, not central banks now, but Chinese investors, the Chinese consumers are buying gold because they're concerned about the fragility of their own banking system. And, they don't have a lot of other places where they want to or can put their money as a security, as a safety. You don't buy real estate if you're Chinese right now. The stock market has gone down for the last 18 months. Doesn't look like a safe place to put your money. They're not allowed to buy crypto. So gold is a safe place. So both of those factors, those are the two major drivers of gold over the last 18 months and including into this year. And they're not reflections of catastrophe on the global scale. So I think what's going to happen in the near term is we're going to get in the West, led by the US, but also in Canada and in Europe, we're going to see interest rates come down. We've seen it in Canada a couple of times, of course. We've seen it in Europe. And we're just waiting for the Federal Reserve to cut rates. And typically, when the Fed cuts rates, gold always moves up from there. We'll see a slowing economy, and a slowing economy is actually positive for gold. Because when the economy slows, investors look ahead and say, that means more easing on the part of the Federal Reserve, which is positive for gold. So the things I'm talking about, a slowing economy, is not a particularly positive environment, but I think, again, it's not a global catastrophe if we have a slowing economy and cutting interest rates. And that's what's going to spur gold.
In a startling display of fiscal expansion, the United States national debt has skyrocketed at an unprecedented rate, leaving economists and policymakers grappling with its long-term implications. Just a few years ago, in the summer of 2017, the prospect of a $20 trillion federal debt seemed daunting. Fast forward to today, and that figure has not only been surpassed, but has ballooned by an additional 75%. The current federal debt is a staggering $35 trillion, increasing at a mind-boggling rate of $330 million per hour. This translates to $7.9 billion per day and an annual increase of $2.8 trillion. Even more alarming is the projection that the national debt will exceed $40 trillion within the next 3 years, effectively doubling since 2017. The government's traditional approach of printing more money to address this issue is fraught with limitations. Major buyers of U.S. debt, notably China and Russia, have been reducing their holdings or outright selling their positions. This shift in the debt market could potentially lead to significant challenges in selling U.S. debt in the future, further complicating the country's fiscal strategy. Let's get back to the interview.
There's an old saying, I wish I could remember who said it, but there's no saying there's an awful lot of ruin in a country, meaning that, it can take a long time for a country on the wrong path with the wrong economic policies. It can take a long time for that to lead to, economic ruin. And the larger the country, the wealthier the country, the longer it takes. And particularly if you were, in the case of the US, if you were the world's reserve currency, where basically you could print as much money as you wanted, knowing that other people around the world would have to buy it. But any wealthy country can build up, a wealth of infrastructure, a wealth of savings. And so wrong economic policies just take a long, long time to lead to economic ruin. But we're getting to the point in the U.S., I think, if you look at the lower 50%, and I'm focusing on the U.S. because obviously it's the largest economy, but it's also where I am. The lower 50% of the population in terms of income and in terms of assets are really beginning to struggle on a truly fundamental basis. The majority of people in the U.S. could not put their hands on $3,000 for an emergency. I would say probably 30 to 40% of people in the U.S. are living paycheck to paycheck. So when the paycheck comes in, they have to decide, what do we spend it on? The paycheck's gone, there's nothing left. I think we're getting to the point where that's really going to spill over into some very, very hard economic times for people. You've seen over the last 18 months, consumer spending has continued to go up in the U.S., and that's an aggregate, of course. So there's wealthy spending, there's poor people spending. But interestingly, consumer spending has gone up at a lower rate than inflation. So what that means is people are not continuing to buy the same amount of goods and services that they were. They're already cutting back because of inflation. But more significantly is that you've seen the savings rate after the COVID lockdowns, when savings went up, you've seen the savings rate come back to pre-COVID levels, in fact, come back to like 10-year lows. And you've seen credit card debt explode upwards in the US. So what this means when you think about it from a personal point of view, it means the person that was buying stuff for his family 2 years ago is continuing to buy most of those things for his family, but is not out of income, but out of debt. And that simply cannot go on forever, especially when the credit card companies are charging people, as much as 30 and 32% interest on their credit card balances. That simply cannot go on much longer. Now, yes, the government can just, print more money and, just distribute more money to people. but that leads to problems at the extreme. That leads to problems, in trying to sell your debt. We're seeing the groups that were the major buyers of US debt are either no longer buying or are actually selling. So Russia obviously is out, unique reasons. But China is also selling down their US debt reasonably aggressively. I mean, we could say 10 years ago, but they were continuing to buy, but at a lower rate than the pace than they were in the past. But now they're actually net sellers.
As the debt continues to mount at this alarming pace, questions arise about the sustainability of current economic policies and the potential long-term consequences for future generations. The situation calls for a serious reevaluation of fiscal policies and a concerted effort to address this growing financial burden before it reaches a point of no return. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.